Mortgage. Happy Friday. Wanted to give you a little bit of color of what is going on in the market. By the way, I want to let you know for the next few weeks, we're going to start getting these emails on Monday because the next, not this coming Friday, but 2 Fridays after that, we are going to be having the Passover holiday, and I am not going to be around for recording these videos. So what is going on? This has been a really wild week. The Fed met. Jerome Powell, he bumped the rates 1/4 of a point, but what he said was important. Jerome Powell said he sees room for maybe one more increase. His exact words were that their plot is showing a target rate of 5.1%. Right now, they're between 4.75 and 5, which means one more 1/4 point increase. Will that happen? I'm not sure. At this last Fed meeting, the experts were truly mixed on whether or not there was going to be an increase in rates or they were going to hold it flat. Some folks were even calling for rates to fall. Now, I got to give Jerome Powell credit. Of course, even a blind squirrel can find a nut every once in a while. He finally pointed out that housing prices, the housing component of the CPI is starting to show some of the effects of the rate hikes, and that the CPI, the housing component of the CPI, is going to start coming down, but it's a lagging indicator, which we know because it's looking at lease contracts that were signed a year ago. And as leases are coming up for renewal, we're actually seeing 5.7 to 6.4% increases year over year, rather than the 11 to 17%, 20% that we were seeing previously. So because of that, and because of that lagging indicator, we're going to see the CPI numbers coming down. Next month is probably going to be a mixed report, but starting May 10th, we're going to probably see a pretty drastic reduction in the CPI. What else is going on? I think Diane Olnick, she is a reporter who loves to scare people that the sky is falling. That is like her theme. The sky is falling. And predicting a great real estate crash every single freaking year. And I guarantee you, if she does this for the next 100 years, she's going to be right one of them. This is not the one. She was telling everybody the sky is falling because for the first time in many years, the median home sales price dropped 0.2%. Well, she's trying to tell people that that means that their home value is going down. For most of America, home prices aren't going down. The reason that the median sales price is going down, and we've covered this in the last few weeks, is because you have move-up buyers that are not buying as much. You've got more folks, I believe it's like 28% now that are doing cash purchases. You've got more investors. You've got more first-time home buyers. So the median sales price is basically the price of the middle house that is sold. Well, if more of your houses that are selling are cheaper houses, then of course the median, or let's say less costly houses, then of course the median sales price is going to decrease. That makes sense. But it doesn't mean that the home values are decreasing, because if you take a look at the same exact house this year versus last year, that same exact house is still selling for a bit more. On an average, I believe it's somewhere in the neighborhood of about 3 to 5%. We've also got some pretty interesting stuff that is going on in the markets, the capital markets. Do you ever watch when a team owner of a football team comes out and says, we have complete confidence in our coach and general manager. He's going to be there. He is our guy. And then you just hit your stopwatch because you know within the next 2 weeks they're going to have a new coach. Right now, we've got Janet Yellen, we've got President Biden, we've got Jerome Powell, and they're all yelling that the banking system is fine. The banking system is fine. It's secure. The stuff that we've done, there's nothing to see here. But what did they do? They basically opened up a nearly unlimited facility for banks to borrow from the Fed on the Treasury securities that they purchased a year or two ago, that they are currently under par. That means, they've got lower interest rates. Their rates are like 2%. And currently, the rates that you're able to sell these securities for or buy these securities for are at like 5%. So if they're going to try to sell these securities, they're going to lose a significant amount of money. So what they're saying is, hey, we're going to pledge these securities. The Fed is letting them pledge these securities at face value, the amount they purchased them for that line of credit, rather than the market value. And banks have rushed. They have already borrowed $400 billion of this money from the Fed. Okay, hey, so why is that so much of an issue? Well, if you take a look, the Fed is currently charging 4.75% for these assets that are making 2%. That's like you going and swiping your credit card to get a cash advance and then taking that money and putting it in a money market account and losing the spread. We know cash advances are expensive. This is like the bank's equivalent of a cash advance. The other thing that's happened that's really causing a lot of challenges in the market is this whole Credit Suisse bailout, because they turned the markets on their head. What they did is they said, hey, equity holders, stockholders, you're going to get 20 cents on the dollar for your stock. Hey, that's freaking great. We're getting 20%. But they have these convertible bonds that they sold back in 2008, 2009. Bondholders are supposed to be higher in the hierarchy than stockholders. And this deal wiped them all out. That's creating a lot of fear and instability for institutional bondholders in the market. In fact, that's led to DeutsheBank being in trouble because they don't know, the bondholders there don't know if their investments are going to be wiped out. So now we've got another big bank in trouble. I mean, this is a ginormous bank. Other things that we want to take a look at right now, durable goods orders came down way more than was anticipated. And what are durable goods? They're things like refrigerators. They're large purchases like cars that you're going to keep for more than 3 years. They're generally financed, but because interest rates have gone up so much, folks are not buying these items. What is going on in the greater Houston market? Right now, we are seeing HAR listing views are down. That could be because of rodeo and spring break. Folks are a little bit distracted. Closings are only down 22% year over year. So interest rates have more than doubled, but closings, they're only down 22%. That's a pretty healthy market. We really don't have a whole heck of a lot of inventory. New listings, we've only got 2,435 new listings over that last week. Pending listings are also down, but there's not a lot of inventory. So the big story is we don't have a lot of inventory right now. Interest rates are going to be falling. I'm already starting to see some of my customers in these smaller bidding wars. So as interest rates go down, there's going to be a lot more demand, and we don't know if we're going to have the housing inventory to meet with the demand. So that creates the potential for more bidding wars. If you have any questions, give me a call. This is Rich with Cross Country Mortgage, 281-841-1723.